Hey everyone, it's Graham Stephan here. Today we're diving into a powerful real estate strategy that can be a game changer for both buyers and sellers seller financing. Now you might be thinking, seller financing? What's that? Well, put simply, seller financing is when the seller of a property acts as the bank, providing a loan to the buyer directly. Instead of the buyer getting a traditional mortgage from a bank or lender, they make payments to the seller. Think of it like this, you're essentially cutting out the middleman, the bank, and creating a more direct path to home ownership. Now you might be wondering, why would a seller want to do this? Why not just have the buyer get a regular mortgage? Well, as we'll explore, there are some compelling advantages for both parties involved. In today's market, seller financing is becoming increasingly relevant. With rising interest rates and tighter lending standards, it can be challenging for buyers to secure traditional financing. This is where seller financing can be a lifesaver. For buyers who may not qualify for a conventional mortgage, seller financing can open doors to home ownership that would otherwise be closed. This could be due to credit challenges, self-employment income, or simply not meeting the strict requirements of traditional lenders. On the flip side, sellers can benefit from attracting a wider pool of potential buyers by offering this flexible financing option. In a competitive market, seller financing can be a powerful tool to make your property stand out and attract more offers. So we've established that seller financing can be advantageous for both buyers and sellers. But is it truly a win-win situation? Well, like any real estate strategy, there are potential benefits and drawbacks to consider. For buyers, the biggest draw is often the accessibility and flexibility that seller financing provides. It can be a pathway to home ownership when traditional financing is out of reach. Plus, seller financing often comes with less stringent qualifying criteria and potentially more favorable loan terms. Sellers, on the other hand, can benefit from a faster sale, potentially higher selling prices, and a steady stream of passive income from the buyer's mortgage payments. However, it's crucial to weigh these advantages against the risks involved, such as the possibility of buyer default or challenges in recouping the property. So we've touched on the advantages of seller financing for buyers, but let's delve a little deeper. Imagine this. You've found your dream home, but traditional lenders are giving you the runaround due to your self-employment income or maybe a credit score that took a hit a few years back. Frustrating, right? This is where seller financing can be a game changer. It often comes with more lenient qualifying criteria compared to banks. Sellers are often more understanding of individual circumstances and may be willing to work with buyers who don't fit the mold of a traditional borrower. And it's not just about qualifying. Seller financing can also offer more favorable loan terms. Think potentially lower interest rates, flexible down payment options, and even customized repayment schedules to fit your budget. This level of flexibility can make home ownership much more attainable. Now imagine securing a loan with a lower interest rate than what banks are currently offering. Over the life of the loan, this could save you tens of thousands of dollars. That's money back in your pocket to invest, save, or even use to renovate your new home. Now let's flip the script and talk about why a seller might choose to finance a property. In a competitive market, sellers are always looking for ways to make their properties more attractive to potential buyers. This is where offering seller financing can be a major selling point. Think about it, you're not just selling a house. You're offering a financing solution that can be incredibly appealing, especially in a market where buyers might be struggling to secure traditional mortgages. This can significantly broaden your buyer pool, leading to a faster sale. But it's not just about selling faster. Seller financing can also translate into a higher selling price. When buyers have access to flexible financing options, they might be willing to pay a premium for that convenience. Plus, with a wider pool of potential buyers, you're more likely to receive multiple offers, driving up the final sale price. And here's an added bonus. Seller financing can provide a steady stream of passive income. As the buyer makes their mortgage payments, you receive regular cash flow, much like collecting rent, but without the hassle of being a landlord. This can be a great way to supplement your income or even plan for retirement. Now, while seller financing offers a world of potential benefits, it's important to approach it with a balanced perspective. Like any real estate transaction, there are inherent risks and drawbacks that both buyers and sellers need to be aware of. For buyers, one of the main concerns is the possibility of defaulting on the loan. Since the seller is acting as the lender, defaulting could mean losing the property and any payments made towards the principal. It's crucial to have a solid understanding of the loan terms and your ability to make consistent payments. Another potential drawback for buyers is that seller financing often involves shorter loan terms compared to traditional mortgages. This could translate into higher monthly payments. It's essential to carefully analyze the loan amortization schedule and ensure the payments align with your budget. For sellers, the biggest risk is the possibility of buyer default. If the buyer stops making payments, you might have to go through the foreclosure process to reclaim the property, which can be time-consuming and costly. It's crucial to carefully vet potential buyers and consider their financial stability. While seller financing can be a fantastic opportunity for buyers, it's not without potential downsides. Stepping into a seller finance deal without understanding the risks is like navigating a maze blindfolded. You might stumble upon the finish line, but it's more likely you'll bump into a few walls along the way. One of the most significant risks for buyers is the potential for scams or predatory lending practices. Remember, in seller financing, the seller essentially acts as the bank. While many sellers are ethical and trustworthy, there's always a risk of encountering someone looking to take advantage of unwary buyers. Another potential pitfall is the possibility of hidden costs or unfavorable loan terms. Unlike traditional mortgages, which are heavily regulated, seller financing agreements can be more flexible. This flexibility can be a double-edged sword, potentially leading to higher interest rates, balloon payments, or prepayment penalties if you're not careful. It's also crucial to consider the due diligence required on your end. As a buyer, you need to thoroughly vet the property and the seller just as you would with a traditional mortgage. This includes obtaining a property inspection, title search, and appraisal to ensure you're making a sound investment and that the property is free of any liens or encumbrances. Finally, remember that defaulting on a seller-financed loan carries significant consequences. Unlike traditional mortgages, where you might have some legal protections, defaulting on a seller-financed loan could lead to a much faster foreclosure process. This means you could lose the property and all the equity you've built, potentially facing financial setbacks that are much harder to recover from. Section 2, Seller Concerns, protecting your investment. Now let's shift gears and delve into the perspective of the seller. While offering seller financing can be a strategic move, it's not without its share of concerns. Think of it like this, as you're not just selling a property, you're essentially stepping into the shoes of a lender, taking on a certain level of financial risk. One of the most significant concerns for sellers is the risk of buyer default. Imagine this. You've sold your property, patiently waiting for those monthly payments to roll in, but suddenly they stop. The buyer has defaulted, leaving you with the daunting task of recouping your investment. And it's not just about the financial hit. Dealing with a default can be a logistical nightmare. You might have to navigate the foreclosure process, which can be time-consuming, expensive, and emotionally draining. And if the property has lost value or requires significant repairs, you could be left with a substantial financial burden. Another concern for sellers is ensuring they comply with all applicable state and federal lending laws. Seller financing regulations can be complex and vary significantly from state to state. Failing to comply with these regulations could expose you to legal challenges, financial penalties, or even jeopardize the entire transaction. Then there's the issue of opportunity cost. By opting for seller financing, you're essentially tying up your capital in the property until the buyer pays off the loan. This might limit your ability to reinvest those funds in other potentially more lucrative investment opportunities. Section 3, Mitigating Risks, Due Diligence and Legal Safeguards. We've explored the potential risks of seller financing for both buyers and sellers. Now let's focus on the crucial aspect of mitigating these risks, Think of it as building a safety net. You hope you never have to use it, but it's there to catch you if you fall. For buyers, due diligence is paramount. This means thoroughly researching the seller, scrutinizing the loan terms, and obtaining an independent property appraisal to ensure you're getting a fair deal. Don't be afraid to ask questions, and if something doesn't feel right, trust your instincts and walk away. It's also crucial to consult with a real estate attorney experienced in seller financing. They can review the contract, ensuring it protects your interests and complies with all applicable laws. A real estate attorney can be your advocate, guiding you through the complexities of the transaction and safeguarding your rights as a buyer. For sellers, mitigating risks starts with carefully vetting potential buyers. This involves reviewing their credit history, verifying income, and assessing their overall financial stability. Remember, you're essentially becoming their lender, so it's crucial to have confidence in their ability to repay the loan. Obtaining a professionally drafted promissory note and mortgage or deed of trust is non-negotiable. These legal documents outline the loan terms, repayment schedule, and consequences of default, protecting your interests as the lender. A clear and comprehensive agreement can help prevent misunderstandings and disputes down the road. Section 1, structuring a seller-financed deal, key components. All right, so we've covered the benefits and risks of seller financing, but how do you actually structure a deal that works for both parties? Think of it like building a house. You need a solid foundation and a clear blueprint to ensure a successful outcome. The first key component is the promissory note. This legally binding document outlines the buyer's promise to repay the loan, specifying the loan amount, interest rate, repayment schedule, and consequences of default. It's like the contract of the agreement, laying out the ground rules for both sides. Next comes the mortgage, or deed of trust. This document provides security for the loan, giving the seller, the lender, a legal claim to the property if the buyer defaults. It's like an insurance policy for the seller, ensuring they have a way to recoup their investment if things go south. The loan-to-value, LTV ratio, is another crucial consideration. This refers to the amount of the loan compared to the property's appraised value. A lower LTV ratio, say 80% or less, generally indicates lower risk for the seller, while a higher LTV ratio, say 90% or more, might involve higher interest rates or additional safeguards. Finally, you'll need to determine the loan term, which is the length of time the buyer has to repay the loan. Seller-financed loans typically have shorter terms than traditional mortgages, often ranging from 5 to 15 years. Shorter terms can benefit the seller by providing quicker access to their capital, while longer terms might offer lower monthly payments for the buyer. Section 2, setting the stage. Negotiating terms and conditions. Now that we understand the key components, let's talk about negotiating the terms and conditions of a seller-financed deal. This is where both parties come to the table, expressing their needs and working towards a mutually beneficial agreement. The interest rate is often a focal point of negotiation. Sellers will want to secure a rate that compensates them for the risk of lending money and for tying up their capital. Buyers, on the other hand, will aim for a rate that's competitive with market rates or even slightly lower, given the inherent advantages of seller financing. The down payment is another crucial factor. A larger down payment reduces the seller's risk and can often result in more favorable loan terms for the buyer. Sellers might be willing to accept a smaller down payment if the buyer offers other incentives, such as a higher interest rate or a shorter loan term. Amortization, or how the loan is paid down over time, is also open for discussion. A fully amortizing loan ensures that each payment goes towards both principal and interest, gradually reducing the loan balance. Alternatively, a partially amortized loan might involve smaller monthly payments with a larger balloon payment due at the end of the term. Don't forget about prepayment penalties. Sellers might include these to protect themselves from losing out on interest income if the buyer decides to pay off the loan early. Buyers, however, will want to minimize or avoid prepayment penalties, giving them the flexibility to refinance or sell the property without incurring additional costs. Section 3, legal and financial considerations, dotting your I's and crossing your T's. Once you've negotiated the terms, It's time to address the legal and financial aspects of the deal. This is where meticulous attention to detail is crucial to ensure a smooth and legally sound transaction. Both parties should consult with experienced real estate attorneys to review the promissory note, mortgage, or deed of trust, and any other relevant documents. An attorney can help identify potential loopholes, ensure compliance with state and federal regulations, and protect your interests throughout the process. Obtaining a professional appraisal is non-negotiable. This provides an independent assessment of the property's market value, ensuring that the loan amount is appropriate and that both parties are entering into the deal with accurate information. Title insurance is another crucial safeguard. It protects both the buyer and the seller from any unknown title defects or claims that could arise after the sale. Imagine discovering after the fact that there's a lien on the property or that the seller didn't have clear ownership. Don't overlook property taxes and insurance. It's essential to establish a clear process for paying these recurring expenses. The buyer might make monthly payments to the seller, who then handles these costs, or the buyer might pay them directly to the relevant authorities. Finally, consider creating a formal written agreement outlining responsibilities for property maintenance and repairs. This helps prevent misunderstandings and disputes down the road, ensuring both parties are clear on their obligations. Section 4, safeguarding your interests, protecting against default and disputes. Even with meticulous planning, there's always a possibility of default or disputes arising in a seller-finance transaction. While you can't eliminate all risks, implementing safeguards can help minimize potential losses and headaches. For sellers, one crucial step is to thoroughly vet potential buyers. This includes reviewing credit reports, verifying income and employment history, and assessing their overall financial stability. Remember, you're essentially acting as a bank, so it's crucial to be confident in the buyer's ability to repay the loan. Consider including a due-on-sale clause in the mortgage or deed of trust. This clause allows you to accelerate the loan, demanding full payment if the buyer sells or transfers the property without your consent. It helps maintain control over the transaction and prevents the buyer from simply passing on their financial obligations to someone else. For buyers, seeking legal counsel throughout the process is paramount. An experienced real estate attorney can help you understand the terms of the agreement, identify potential red flags, and protect your interests in case of disputes with the seller. Maintaining open communication with the seller is crucial. If you encounter financial difficulties or anticipate challenges in making payments, reach out to the seller as soon as possible. Open dialogue can often lead to mutually agreeable solutions, potentially preventing a minor issue from escalating into a default. And finally, both parties should document all communication, agreements, and transactions related to the seller-financed deal. This creates a paper trail that can be invaluable in case of disagreements or legal disputes, providing evidence of the agreed-upon terms and actions taken by both sides. Case Study 1. The aspiring entrepreneur and the supportive seller. Let's bring seller financing to life with a real-life example. Meet Sarah, an aspiring entrepreneur with a dream of opening her own bakery. She had a solid business plan and the passion to make it succeed, but traditional lenders weren't biting. Her credit history was limited due to being a recent graduate, and her income, while promising, wasn't yet at the level required for a commercial loan. Sarah stumbled upon a charming storefront for sale in a bustling neighborhood. It was perfect for her bakery, but securing financing seemed impossible until she discovered seller financing. She approached the owner, a seasoned entrepreneur himself, who understood the challenges of starting a business. Impressed by Sarah's vision and determination, the seller agreed to finance the purchase. They structured a deal with a 10% down payment, a slightly higher interest rate than commercial loans at the time, and a 7-year loan term. This structure provided the seller with a steady stream of passive income, while allowing Sarah to launch her dream business without drowning in debt. Fast forward 3 years, Sarah's bakery is thriving. She's built a loyal customer base, expanded her menu, and even hired additional staff. She's consistently made her loan payments on time and is well on her way to owning her bakery outright. This case study exemplifies how seller financing can empower aspiring business owners to achieve their entrepreneurial dreams. Case study 2, turning a rental property into a seller-financed success. Now let's shift our focus to John, a homeowner looking to sell his rental property. He'd owned the duplex for several years, generating steady rental income, but managing tenants and handling repairs was becoming increasingly time-consuming. He wanted to cash out his investment and diversify his portfolio. John listed the property for sale, but traditional buyers were scarce. The rental market in his area had softened, and potential buyers were hesitant to take on the responsibilities of being a landlord. John was starting to feel discouraged until he explored the option of seller financing. He restructured his listing to highlight the seller financing option, attracting a young couple eager to enter the real estate market. They loved the idea of owning a duplex, generating rental income to offset their mortgage payments. But their savings weren't quite enough for a large down payment on a conventional loan. John and the couple negotiated a seller finance deal with a 15% down payment, a competitive interest rate and a 10-year loan term. The agreement included a clause stating that the couple would continue managing the property as landlords, ensuring continuity for the existing tenants. This scenario demonstrates how seller financing can breathe new life into a stagnant real estate listing, benefiting both the seller and the buyer. Section 3. Case Study 3. Navigating a win-win solution in a challenging market. Imagine a scenario where the real estate market is experiencing a downturn. Property values have dipped and traditional lenders are tightening their lending standards, making it challenging for buyers to qualify for mortgages. This is where seller financing can become a lifeline for both parties. Meet Emily, a homeowner facing a job relocation. She needed to sell her home quickly but was finding it difficult to attract buyers in the current market. Traditional buyers were scarce, and those who were interested were often lowballing her with offers significantly below market value. Enter Mark, a savvy investor seeking to expand his real estate portfolio. He recognized the potential in Emily's property, but knew securing a traditional mortgage in the current climate would be challenging. Aware of the situation, Emily proposed seller financing as a solution. They agreed upon a purchase price slightly below market value but still favorable for Emily considering the circumstances. They structured the deal with a 5% down payment from Mark, a competitive interest rate and a 7-year loan term. This agreement allowed Emily to sell her property quickly, albeit at a slightly lower price, while enabling Mark to acquire a valuable asset with minimal upfront investment. Section 1. Seller financing, a powerful tool in your real estate arsenal. As we've explored throughout this video, seller financing is a multifaceted real estate strategy with the potential to unlock opportunities for both buyers and sellers. It's not just about buying or selling a property, it's about forging a direct path to achieving your real estate goals, often when traditional methods fall short. For buyers, seller financing can be the key to unlocking the door to home ownership, especially in today's challenging market. It offers a level of flexibility and accessibility that traditional lenders often can't match. Imagine bypassing the stringent criteria of banks, negotiating favorable loan terms, and crafting a repayment plan that aligns with your unique financial situation. For sellers, embracing seller financing can be a strategic move to attract a wider pool of buyers, potentially command higher selling prices, and even generate a steady stream of passive income. In a competitive market, offering this flexible financing option can be the differentiator that sets your property apart and entices eager buyers. Section 2. Weighing the scales. Is seller financing right for you? Now, while seller financing presents a world of possibilities, it's not a one-size-fits-all solution. Like any real estate strategy, it's crucial to approach it with a balanced perspective, weighing the potential benefits against the inherent risks. For buyers, due diligence is paramount. Thoroughly research the seller, scrutinize the loan terms, obtain an independent property appraisal, and consult with a real estate attorney experienced in seller financing. Remember, knowledge is power, and understanding the intricacies of the deal is crucial to protecting your interests. For sellers, mitigating risks starts with carefully vetting potential buyers, ensuring they have the financial capacity to repay the loan. Drafting a comprehensive promissory note and mortgage or deed of trust is non-negotiable, providing legal protection and outlining the terms of the agreement in clear, concise language. Section 3. Unlocking possibilities, your next steps in the world of seller financing. If you're intrigued by the potential of seller financing, your journey doesn't end here. Take the next step by diving deeper into the world of seller financing. Connect with experienced real estate professionals in your area, including agents, attorneys, and financial advisors, specializing in this unique financing method. Explore online resources, attend webinars, and immerse yourself in the knowledge and insights shared by experts in the field. The more you learn, the better equipped you'll be to navigate the intricacies of seller financing and make informed decisions that align with your real estate goals. Remember, the real estate landscape is constantly evolving, and embracing innovative strategies like seller financing can empower you to adapt, thrive, and achieve your dreams. Whether you're buying your first home, expanding your investment portfolio, or simply seeking a more creative and flexible approach to real estate transactions,